Sometimes the media takes a sensationalist view of these things. There's an old saying that you should look at what people do rather than what they say. But the big macro trend at the moment, the US economy, there's just trillions of dollars of stimulus being poured in. Interest rates around the world are record lows. This has tended to be quite good for asset prices. Almost any way you look at it, Australia put in place a massive stimulus. We were quite lucky in the sense that we didn't have a high level of government debt to begin with. So there was a lot of headroom there for Australia to effectively borrow. The government could issue a lot of bonds, and all of the payments that went out there. So there were things like the JobKeeper and the JobSeeker stimulus. The housing market got plenty of stimulus in terms of construction. And also we had the Reserve Bank cutting interest rates, which we did have room to do, and then quantitative easing on top. So the stimulus was absolutely huge in Australia. I think the virus is in some ways accelerated a trend that was already there. So the impact of that is with Aussies not being able to travel, all of those Aussie dollars have been stuck in the domestic economy. And up until a few weeks ago, the economy was absolutely booming back. So unemployment was back under 5%. We had job vacancies at the highest level on record. Construction was booming. The world's in a bit of a state of flux at the moment, and it might take a while for the pieces of the puzzle to resettle.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested. Hi, freedom fighters. I had a call from Money Magazine this week who asked me why, in the midst of COVID carnage, is property and investment still booming? So in today's episode, I thought we'd compare continued media fear-mongering gloom versus the current and ongoing investment assets boom in equities and property. Another story of poor perception versus rewarding reality, where the actual facts dispel the fears. Since early 2020, it's fair to say that we've been buried in a continuous deluge of 24/7 newsreels painting gloom and doom for many industries and individuals. The constant threat of reactive rolling lockdowns is seeing in excess of 60% of Aussies confined to their homes. And with international borders closed indefinitely, population growth has ground to a halt. Yet despite this negative backdrop, investment asset prices continue to boom. On the equities front, after an initial sharp 30% drawdown following the COVID pandemic discovery, the Australian share market has been rising steadily, taking nearly 12 months to recover to pre-COVID levels, and then continuing to grow sharply 10% above the pre-COVID peak at the current historic high, with the All Ords index sitting just below 8,000 as we speak today. And the US stock market, representing over 60% of the global equities pie, has seen similar dramatic growth, with the S&P 500 up nearly 35% since the onset of the pandemic, and currently trading at the historic high of over 4,400. And similarly on the property front, according to latest CoreLogic figures, Dwelling values have soared nationally by an average of 14.1% over the last 7 months and 16.1% higher over the past 12 months, with strong price rises occurring in 94% of regions across the country. Now, breaking this down over the last year, the regions have outpaced the capital cities in property, with the regions rising 25.1% and the combined capitals growing by 18.6%. And on a state basis, Darwin has enjoyed the highest level of growth at 23.4%, followed by Hobart at 21.9%, Canberra at 20.5%, Sydney at 18.2%, Brisbane at 15.9%, Adelaide at 15.7%, Perth at 10.8%, and Melbourne grabbing the wooden spoon at 10.4%. Now, to put this in context, these growth rates compare with the long-term national average of just 6.8% annual growth that's been achieved over the last 25 years. So, as you can see, the current level of growth is 2 to 3 times that in many parts of the country. And the number of home sales has also held well above the average over the year, with CoreLogic estimating a 42% year-on-year lift in the number of sales. They note that the annual number of home sales has not been this high since the year ending January 2004. And the past 12 months has seen nearly 600,000 dwellings sold across the country, with 31% more sales than the decade average. And again, despite media stories to the contrary, rental markets also remain tight, with the annual pace of growth in national rents lifting to 7.7%, according to the latest CoreLogic figures, the fastest rental appreciation since way back in 2008. And beneath the national figures, it's clear that rental markets remain diverse. Rental conditions across Darwin and Perth are the tightest amongst the capitals, reflecting low vacancy rates and high rental demand. Both cities saw a substantial reduction in investment activity from 2014, which has likely contributed to the short supply of rental accommodation. At the other end of the spectrum are the apartment sectors of Melbourne and Sydney, where rental conditions have been substantially looser. The good news for landlords is that rental markets in these areas are stabilising following a substantial reduction in rents due to high vacancy rates attributable to stalled overseas migration and a preference shift away from high-density living during the pandemic. And with housing values outpacing rents, gross rental yields have trended lower. The national gross yield has reduced from 4.1% 2 years ago to just 3.4% in July this year, which is a record low. The most significant yield compression has been in Sydney, where gross yields have fallen to just 2.5%, and in Melbourne to only 2.8%. Every other capital city is recording gross yields at 4% or higher. Now, considering mortgage rates on new investment loans are averaging around 2.5 to 2.8%, gross rental yields outside of Sydney and Melbourne are likely to be providing opportunities for positive cash flow investment opportunities. Considering yields outside of Sydney and Melbourne are high relative to mortgage rates and housing values are expected to rise further, we're likely to see investment activity continue to lift. Now, you may be thinking that this just doesn't make sense. How can the media perception be so far off the reality mark? But to understand why, we need to see investment markets as being like a grass fire in the middle of a large pile of lawn clippings, where 3 things are required to burn to create spontaneous combustion: fuel, heat, and oxygen. Using property as an example, the fuel is the number of properties for sale, the heat is the level of demand, and the oxygen is the money supply. And despite expectations to the contrary, COVID hasn't been a killer, it's been a catalyst. It's added petrol, not water, to the investment asset fire for shares and property, generating both heat and adding oxygen. So our current equities and property investment inferno comes down to just 2 key words: scarcity, and spend. Again, focusing on the property example, scarcity has been created by limited properties for sale and pent-up and growing demand. For the 6 months or more after COVID hit, house values looked like that large pile of freshly cut grass. Nothing appeared to be happening, and property prices held their ground, as very few homeowners were able to sell due to lockdown conditions. But under the surface, the heat was building from pent-up buyer demand. Buyers were quarantined at home with nothing to spend their money on, and they were seeking more lifestyle, safety and space to escape the COVID threat. And the oxygen that ignited the house fire is the increase in spend, with billions in government stimulus money, property incentive programs, and the lowest interest rates on record. Now, money has never been more plentiful, and it's never been cheaper to borrow. And property has always been a game of finance. Once the lockdown subsided towards the end of 2020, and frustrated buyers were able to purchase homes, a property firestorm erupted, like releasing a compressed spring. And it's been no different in the equities markets. And very low interest rates means that you're losing money if you're leaving your savings in the bank when inflation's taken into account. And it's cheaper to buy a home than rent, so lots of tenants and adult children still living with their parents, armed with thousands in housing incentive programs, have flooded the market. And many others are taking advantage of the cheap money to upsize, downsize, tree change and sea change, all to improve lifestyle with increased space and safety away from the perceived risk of CBD density. But it hasn't stopped there. The raging house fire has been further fanned by media coverage of the boom, bringing the fear of missing out, or FOMO, into play. More Australians have been fighting for their piece of the action, making the headlines predicting price rises become self-fulfilling prophecies. And we're not going to see an end to this anytime soon. Scarcity is not easily solved, but spend may be slowed when the government, the Reserve Bank and the banks reduce the oxygen supply by potentially tightening lending policy or increasing interest rates. But neither of these is likely to be happening anytime soon. Now, if you want to read my full article on the subject, check out the Money magazine. But in relation to where we're at, what are the major macro and micro trends and the factors that are likely to impact on investment markets in the short to medium term? Will the boom continue? Are we in a bubble? Will it burst, and if so, when? Who do you turn to in order to find out? Well, certainly not the mainstream media, unless you want to continue to scare yourself sick, because their only remaining currency is to stall their pending demise and attract and engage your ears and eyeballs by peddling you a continuous diet of sensationalist fear and greed. A nutritionless fast food diet that will leave you overburdened but undernourished, leaving you burnt out, broken and broke. So where do you turn? Who can you talk to that has a deep understanding and almost intuitive knowledge of the full spectrum of global and local economics and the relationship and impact on current and future shares and property markets? Someone who doesn't have a conflict of interest, a bias, or a vested interest, but can give you real independent and objective views to help you make better informed investment decisions. For my money, the best person to avoid the fear factory fiction and give you the unadulterated facts and meaningful insights is our Get Invested regular, Pete Wargent. As well as being one of Australia's brightest financial minds, Pete's well known to us here on the Get Invested podcast as a 6-time published finance author and leading investment analyst, I'll get it right the third time, on the back of his work as an active investor, a property buyer's agent, a strategist and mentor, where he uses tried and tested strategies to assist you in achieving your financial goals across the broad spectrum of property and equities. Like yours truly, He's on a mission to wake up and shake up hardworking Australians to get invested beyond super in order to attain and maintain your ideal lifestyle long term, and to educate you with quality information so that you can make fully informed investment decisions. And to whet your appetite further on his approach, let's dive into his recent book, Low Rates, High Returns, which sets the scene and gives you a timeless investment strategy to navigate and outperform in the decade ahead. So here's a taste-testing extract. We're living through some extraordinary times. For those of us old enough to remember interest rates above 15% and runaway inflation, an era of interest rates at close to zero once seemed impossible. And yet, here we are. And if financial markets are anywhere near correct, the low interest rate era may be with us for quite some time to come, perhaps even a very long time. Much else has changed in recent decades. Whereas once we were expected to retire and live for only a short time in retirement, today it's entirely possible that you may live in retirement for many years and even decades. With interest rates globally often stuck at close to zero, and apparently little prospect of that changing much soon, many retirees have been forced to eat into their capital. We used to think of fixed interest investments such as cash and term deposits as delivering risk-free returns. But in this respect, the world's been turned on its head over the past decade or so. These days, we get the risk of inflation eating away the value of our capital without the worthwhile returns. But fortunately, there's a better way. We believe that your goal should be to continue growing your wealth throughout your entire lifetime, both into retirement and beyond. We believe the goal should be to be much wealthier when you pass away than when you retire, so that you can live and leave a legacy. Compound growth is known to be the most powerful force in the financial universe, so it makes sense to continue using it to your own benefit for as long as possible. Traditionally, mature investors have shied away from the volatility of the stock market or property in favour of the predictability and safety of cash, fixed interest investments, or annuities. But the low interest rate era has forced many to have a rethink. It's possible to consistently generate acceptable returns without the risk, you ask? Well, it is, but it may require thinking a little differently from what the finance industry typically recommends that you do. We found through our personality assessments that there are a few reasons why people seek financial independence. For high achievers, financial success is usually about achieving significance. For more analytical types, learning how to invest tends to be about security. And for others, still with a freedom of spirit or a more adventurous bent, becoming a successful investor is more about the freedom to do your own thing. Now, the book Low Rates, High Returns helps you to understand markets sufficiently to implement their systemic approach and to manage your own finances, or at least to seek further information so that you can. Understanding your personality traits and motivations is still important because it helps you to recognise your behavioural traits and their potential flaws, because we all have them, and the related risks. We understand that when it comes to investment markets, history does repeat and rhyme. Like many things in life, investment markets have cycles, like a tide that comes in and goes out on a longer time scale. These cycles appear in all investment markets around the world, whether they are in developed countries like Australia or emerging markets such as Turkey. And you can use these patterns and cycles to make money from investments. It isn't rocket science. It just requires the bringing together of a few timeless principles. As the famous investor Peter Lynch once said, everyone has the brain power to make money, not everyone has the stomach. And by stomach, Lynch means emotions. Allowing your emotions to dictate your investment decisions will send you broke in a very short space of time, or at least you'll lose money. The book shows you how to understand what type of investor you are, the first rule of life being espoused by many sages being know thyself, and to avoid succumbing to emotionally based decision making when it comes to your investments. Now, the Japanese have a saying, karada ga abatura. Now, if you were Japanese, I'd probably just butchered that, but it basically means the body remembers. This simply means that after repeated episodes of learning, whether it be karate, tennis, or even playing a musical instrument, you can see and respond automatically to the events that surround you. In Western culture, it's sometimes known as muscle memory. Over time, you can gain enough insight and wisdom to be able to respond calmly to the situations that arise in your daily life. Now, investing is simple, but it's not easy. The simple part, unfortunately, though, comes after the difficult part. And the aim of the book is to make the difficult part as easy as possible. When beginning to take an interest in investing, it's difficult to know where to start. You read a few articles and books and you think you're getting a handle on it all, but the reality is, the more you search for knowledge, the more the questions arise. It's a sort of an endless loop that can be exciting as you gain more of an understanding, but also frustrating as you realise that the loop is indeed endless. So enter timeless investment principles. Along with our personalities, there appear to be certain principles that lie at the heart of many successful investment strategies. Many investors have their favourite set of investment principles, and there's no shortage of them to choose from. Among the many, we've now identified and defined the 8 key principles that we believe are applicable to all asset classes and will stand the test of time throughout the cycles. We note here that there are many principles that are applicable to certain time periods, e.g. the trend is your friend, but they're not timeless. What we want to show you is a strategy for all markets that can work at any time. Truly timeless. A timeless strategy for all markets. Now, after a lot of investigation and refinement, we developed a strategy that you may wish to pursue. Our hope is that you can apply it to yourself to become a successful investor. Investing is not that difficult. So our aim is to give you a strategy as a place to start and to open your mind to what's possible. We believe that anyone can be a successful investor. What we hope to do is convince you that with an understanding of a few crucial concepts, you can gain a good understanding of how investment markets works, and more importantly, how to increase your wealth from investing. Remember that markets don't always go up. Markets move in cycles. So the returns can either be amazing if you buy when markets are cheap, or terrible if you buy when they're expensive. So you need a strategy for all markets, a timeless investment strategy that works in all types of situations. Because fads will always come and go. But a philosophy is important. In investing, it's critical to have a philosophy as well as a system based on a set of principles. Successful investors such as Warren Buffett and George Soros take a systematic approach to investing. And this book talks about the importance of your personality and the reason why it's absolutely critical to your success. If you invest your own money, but you haven't developed a system or underlying philosophy, then you can only be investing based on emotion, gut feel, or instinct. And while these attributes may be beneficial for some areas of your life, we certainly don't recommend them for investing. Investing should be done with a strong emphasis on numbers, history, and probabilities. In our experience, investing based on emotions doesn't lead to superior returns. Many investors invest this way and they fail to understand the importance of having a systemic approach. Now, we've developed ours from our combined decades of observing and investing all over the world, and this philosophy can equally be applied to all investments regardless of whether they're stocks, real estate, bonds, or even vintage cars. And the first part of the investment philosophy is based on the very simple adage, don't lose money. Now, this sounds extremely basic and logical. However, most experienced investors will tell you it's the reward side of investing that gets most of the attention. Even in a low interest rate era, everyone wants to talk about where you can seemingly get high reward investments. Put simply, you'll fail more often in investing as a result of focusing too much on the rewards that, let's face it, are potential rewards in any case, if the risks are routinely ignored. For the past 20 years, we've sought an investment strategy that is low risk but provides an opportunity for high returns. Now, it's probably fair to say that this is considered the holy grail of investing. And of course, everyone wants low-risk investments that deliver high returns. However, that doesn't mean that a low-risk, high-reward portfolio is impossible to achieve. Now, here's the main question you should ask every time you want to invest your money. If I put my money in the bank and they offer me, say, 2%, which is a lot more than you get right now, with a 100% guarantee that I will get it back when I want, but I'm being offered and want more than 2%, then what is the extra risk of losing money? Therefore, you need to develop a risk hierarchy, which is a different way to think about risk and investing. Now, cash is very safe, but it doesn't pay much in terms of reward. At the moment, almost nil interest. But what cash gives you is a safety buffer and optionality, being the ability to capitalise on great investment opportunities when they come around. Compare this with bonds, which are typically very safe and may pay a little more than cash. Stocks or shares will generally do well over time, but there may be a greater risk of losing your money. Now, within shares, there are relatively safer investments like diversified ETFs or exchange-traded funds and indices, as well as relatively riskier investments, such as individual company shares. So here's a different way to think about risk based on key questions that you need to ask yourself. Firstly, how long am I going to invest this money for? 10 weeks, 10 months, or 10 years? This is important because prices change regularly, and depending on your time frame, you shouldn't get frightened by volatility, which is a word simply meaning the fluctuations in price. Secondly, how much do I know about this investment? Are you knowledgeable enough to know what you're doing? For example, in shares, what's the price to earnings ratio? Thirdly, are you investing systematically? Or are you investing or trading because you're bored? Or acting due to some other part of your personality? Fourthly, is the market valuation favourable? Is the asset cheap, average, or expensive? Now remember, every investor seeks a holy grail, an investment strategy that's low risk but delivers high returns. And after 20 years as an investor, co-author Steve has said that successful investing is more about avoiding losses than it is trying to find the next big winner. So the concept of risk relates to a permanent loss of your capital. Now, Warren Buffett's first rule of investing is don't lose money. And the second rule is remember rule number 1. Now, investing is about outlaying money today with a plan to get more back in the future, however short or distant that future may be. And when we speak of risk, we're really talking about possible future outcomes. Risk, in order to be useful in investing, or in fact most situations, must firstly have context to it. In other words, it's a subjective proposition rather than an objective one, which is numbers-based. Most investments are not a 50-50 proposition. Successful betting in horse racing, casino games, or even poker is about finding asymmetrical bets. Asymmetrical means there's a difference between the payoff probabilities and the risk. So, for example, a hand of 4 aces will see you bet heavily in poker, whereas a pair of 3s, not so much. Now, that requires us to look and wait patiently for situations or investment opportunities that are asymmetrical. That is, there's plenty of upside if you're right, but only a little downside if you're wrong. Now, Sam Zell, a US billionaire from real estate investing, explains it like this. Listen, business is easy. If you've got a low downside and a big upside, you go for it. If you've got a big downside and a small upside, you run away. The only time you have to do any work is when you have a big downside and a big upside. Now, professional punters, poker players, or experienced investors look at the odds or risk based on the contextual probabilities in relation to the potential payoff before placing their bets. As Sam says, look for a big upside with minimal downside. So how do we manage risk? By being contrarian. And how do we make investment decisions being contrarian? Firstly, we avoid the crowd because we know that the crowd is unlikely to understand much about the investment and what the risks are. The most successful approach is to have a systemic method that delivers the best probability of you making successful investments based on sensible decisions. As famous investor John Templeton said, it's impossible to produce superior performance unless you do something different from the majority. Now, it's difficult to stand alone, but we can tell you that this is how you can get better than average investment returns in all markets. And with more practice, by using a systemic approach, your emotional framework will become familiar with the approach, so it gets easier over time. And there are investors who do consistently beat the market. And here's a brief summary of how they do it. Firstly, they have a system that they stick to and apply. This is usually based on being contrarian, that is, buying when the market's cheap, and they don't wander off into the latest public fad or whatever's hot. Secondly, they don't follow the crowd or act emotionally. You'll often find that the most profitable investments are made when everyone else is running in the opposite direction. Thirdly, they follow market cycles and understand that there are times when it's better to buy and better to sell. Next, most of them use a rational decision-making approach when allocating their capital. And then they don't put all their allocated funds into the market at once. They average in to an investment because they're aware that even cheap investments in markets can get cheaper. Now, the proof is in the returns generated over a long period of time, and the superior performance of buying and selling investments using the contrarian method works on the fundamental edge that investors like Warren Buffett and George Soros use to beat the market, which is rooted in the psychology of individual investment behaviour. And this approach has been successful for over 75 years. So here are the 8 timeless principles. Developed and honed over time by Steve and Pete, here are the 8 timeless investment principles that you can apply at any time in any markets to any asset class. And it's broken into 2 sets of 4. Firstly, the 4 thought principles. Number 1, systematic investing. If you don't have a systematic approach to investing, then on a long enough timeline, eventually something will not go as planned and you're likely to fail. So plan accordingly. Secondly, personality. There are actually 9 different personality types, and we all have our own motivations, strengths and weaknesses. Understanding your personality type and the dominant beliefs will help you to invest with less emotion and more rationally. Number 3, market cycles and mean reversion. Market sentiment swings higher and lower over time, but over time, valuations, particularly in share markets, have tended to revert to an average or mean level. Number 4, risk hierarchy. Some investments, e.g. individual company shares, may entail a greater risk of permanent loss of capital than others, compared to, say, an all-world exchange-traded fund or ETF that holds more than 1,500 different shares in it. Now let's turn to the second 4, the action principles. So number 5 is asset allocation. Consider investments in uncorrelated assets. For example, cash and shares are uncorrelated, so you might split your capital between these assets. Number 6, buy low, sell high. exactly what it says on the tin. Buying low and selling high is a timeless strategy for all markets and all asset classes. You just need to know how to do it. Number 7, diversification. There are several ways to diversify, including across multiple investments, by investing in products that are themselves diversified and across time by carefully staging your entry to investments. And finally, number 8, rebalancing. This is a critical part of any investor's armoury to ensure that you are never overexposed to any single investment position. Rebalancing helps you to manage your risk and can improve your returns over time. So how can you apply these timeless principles? Well, the principles are simple and very logical, and as standalone principles, they each individually make perfect logical sense. But the true power of the 8 timeless principles is how they interact together in harmony. When you pull them all together, what you have is an investment strategy that can deliver the holy grail of investing. That is, higher than average returns with lower than average risk. Now, we believe these principles form a holistic approach to investing without missing the essence of good investing. We're keen to ensure you can distinguish between the signal, as in good times to invest, versus the noise, the daily media commentary and the sound bites that get in the way. And these principles can be used in any asset class. If you're buying an investment property, well, you can use these principles to determine whether an attractive investment opportunity exists. Each of these principles stands on their own merit. However, the most powerful benefits come from combining them. We use the principles to develop a systemic approach, which ensures that you stay on the right track and avoid becoming tempted to drift. The idea is to use the 4 thought principles, being systematic investing, market cycles, personality, and the risk hierarchy, to think about investments before you invest. This ensures that you've stuck to the process and avoid making decisions based on emotions. The 4 action principles are there to guide you through the actual investment process when it becomes time to act. They show you how much to allocate, as in asset allocation, considering the macro valuation and the market cycles. To assist you apply the principles, the book then discusses diversification, raising issues that you'll need to consider in relation to your overall portfolio. The book shows you how to buy low and sell high to ensure you don't become too greedy at the top and too fearful at the bottom. And finally, the book demonstrates the importance of rebalancing your portfolio and shows you how important it is in contributing to managing your risk and ensuring your investment success. The broad goal of the book is to have you develop a rigorous, systematic approach to investing. Pete and Steve are confident that combining a philosophy of investing with both the thought and action principles will enhance your investment success. So if you want to find out how to apply the 8 timeless principles in practice, grab yourself a copy of Low Rates, High Returns, and then you can use this together with the insights that Pete Wargent shares in our great conversation today to de-risk and boost your investment results and grow your wealth. So in today's very informative conversation, we move from the macro to the micro across equities and property markets to give you all the information that you need to make better informed decisions. And we discuss a whole range of topics, including the major macroeconomic trends, both globally and locally. We touch on what international macroeconomic issues are likely to have the most impact on Australia moving forward. What ongoing impact, if any, will China's policy changes have on our economy? Will the current strength in the economy last? What are the biggest economic risks that need to be considered that are likely to impact on investment markets? What impact, if any, is the ongoing COVID challenge having? What are the current drivers of our investment and property market cycles? Where are the opportunities in property and equities markets? We get Pete's read on asset bubbles and pending busts. We gauge Pete's thoughts on the impacts, if any, of immigration policy, employment rates, inflation, and interest rate policy, as well as rises in employment and their impact on investment markets. Pete shares his views on government and central banks' approaches to asset prices and potential interventions moving forward. We discuss his outlook for property in the short, medium and long term. We discuss potential macro-prudential policy interventions and interest rate movements moving forward, and its potential impact on property markets. And with interest rates at all-time lows and likely to remain there for most of the next decade, Pete reveals what impact this will have on investment and property strategies. On the property front, he outlines locations where clients are buying and seeing value. He discusses the merits and drawbacks of buying property interstate and becoming a borderless investor. He outlines what negotiation strategies can buyers use to secure properties in a hot seller's market. And we conclude with a discussion on why don't more property buyers use a buyer's agent and why property buyers should reconsider using a buyer's agent. And to help property buyers level the playing field, Pete's recently launched a new national buyer's agent business called Buyers Buyers that's harnessing the knowledge of Australia's leading buyer's agents at a price that every Aussie home buyer can afford. So we chat about how you can take advantage of this today, because in the current seller's market, there's never been a greater need to have a good buyer's agent on your team. Now just jump on buyersbuyers.com.au where you can access a ton of free reports and information to assist you with your property buying journey. And there's no doubt that today's conversation will inspire you to go to the next level in your property investment. So no matter where you're at, whether you're a beginner or a seasoned investor that's struggling with your portfolio, I'd like to invite you to join me on our unique Know-How Property Freedom Flight program, where I'll personally guide you through my proven process for property investment success. To book your ticket or just to find out more, just jump on knowhowproperty.com.au/freedom fighters or click the link in the show notes. And if you want to hear more from Pete along with all of Australia's leading property investors and independent property professionals, join me and the other 120,000 or so regular listeners every week as I host the country's most popular and longest running property show, Realty Talk. So I look forward to seeing you on channels.realty.com.au/Realty Talk, where we share short and sharp take-home tips and tricks on all things property. In the meantime, stop listening to the news and instead enjoy this informative investment update with Pete Wargent. Hi, Freedom Fighters. Now, since early 2020, we've been buried in a continuous deluge of 24/7 newsreels by the fear feeders, painting gloom and doom for industries and individuals. And the constant threat of reactive rolling lockdowns is currently seeing, roughly 60% of Aussies confined to their homes. And with the international borders closed indefinitely at the moment, population growth has ground to a halt. Yet despite this negative backdrop, asset prices continue to boom. And on the flip side of the media feeding frenzy are the boom busters, those greed growers that keep talking up asset bubbles and talking about the fact that everything's about to burst in this crazy maelstrom of madness and mayhem. So how do we make sense of this enormous dynamic complexity and the tsunami of often conflicting information that we're drowning in every day? And how do you decipher the BS from a more balanced view? So to offset these very poor perceptions with the actual factual reality and to balance the debate so you're making more informed investment decisions, I wanted to have a chat with a respected industry commentator that invests across all of the major asset classes and can provide you with an open, independent and objective view, unclouded by vested interests. And in this regard, there's no one better than regular Get Invested guest, Pete Wargent of Buyers Buyers. So welcome back to the show and let's get invested, Pete.
Pleasure, Bushy. Always good to talk with you. So looking forward to it.
Yeah, likewise, mate. Now, Pete, for those that haven't heard you on our previous episodes, can you just give us a quick kick-off, refreshing us on who you are, what you do, and most importantly, what's new for you, mate?
Yeah, so as you can hear, I'm British born. I've been in Australia for many years, though. I was originally a chartered accountant. So I was with one of the big four accounting firms. I was a director there. I've been doing my own thing for about 10 years now. Currently invested in a business called Buyers Buyers. So we're a national property buyers agency network. So obviously I've got a lot of interest in real estate, been an investor in property myself for a couple of decades, so quite a bit of experience there. But as you pointed out there, I do have a big interest in the macro environment and economics and investing. So I tried to take a big picture view. So hopefully we can cover a few of the big prevailing trends at the moment and try and make a bit of sense of it.
Yeah, that's brilliant, mate. And that's exactly what I think we'll do today. We'll dispel some of the myths, and we'll start at the macro level, and then we'll drill down to what I call the micro and then the micro. So to sort of kick that off in that regard, what are you seeing as the major macro trends that are happening globally and affecting locally?
Yeah, well, we can't get away from discussing COVID at the moment, whether we wanted to or not. It's all over the media. Obviously, that's the major global issue. Now, interestingly, at the time of speaking, I'm actually over in Europe. So it's with the border closures, difficult for me to get the family back into Australia. But it is interesting from a European standpoint. Life has gone pretty much back to normal. So in Australia, in recording this in the middle of August, it feels like it might never end, but the vaccine rollout is picking up. It's interesting. I mean, I've been traveling around the UK. I was in Portugal for a couple of weeks. So travel around Europe is happening again. And interestingly, you wouldn't even really know that there had ever been an issue now. You know, people have gone back to living life again as normal. So Australia is still right in the midst of its lockdowns and vaccination rollouts, but it is interesting to see there's life on the other side. I think from a timing perspective, it might take until next year, though, before the vaccine rollout has got sufficient coverage. So there's a bit of an ongoing struggle, but obviously this is the major global issue at the moment. There's been a lot of stimulus poured in around the world in terms of monetary and fiscal policy. So that's keeping the global economy ticking over. And that's particularly true in Australia because the lack of international travel has kept all of those Aussie dollars trapped at home. So the global economy is struggling along, but Australia is doing surprisingly well.
Yeah. So outside of COVID, are there any other major macro movements that you're seeing globally and locally that are impacting on investment markets?
Yeah, I mean, I guess the big trend over recent decades has been towards globalization, but that's really been fractured in the last few years. You know, people like to point the finger at Donald Trump, but there's more to it than that. So I think the virus is in some ways accelerated a trend that was already there. So there's a lot less freedom of movement at the moment. Australia's got a few of its own issues in terms of its relationship with China. So yeah, the world's in a bit of a state of flux at the moment, and it might take a while for the pieces of the puzzle to resettle. But yeah, I mean, the big macro trend at the moment, I mean, the US economy, there's just trillions of dollars of stimulus being poured in. Interest rates around the world are record lows. So, I mean, this has tended to be quite good for asset prices, but obviously there's a lot of other challenges going around at the moment as well.
Yeah, spot on. You mentioned China, and again, the mainstream media likes to beat that drum a fair bit in terms of the so-called gloomy future as China sort of starts to withdraw from its relations with us. What's your read on all of that?
Yeah, I mean, I suppose there's an old saying that you should look at what people do rather than what they say. And there's clearly been a big issue over the past year or 18 months with the lack of international students and lack of international tourists. China, in both cases, had become our number one source of new arrivals, particularly short-term arrivals. And that is really, there's major disruption there, and also with the lack of international travel. So that has had a direct impact. In terms of exports outside of the services sector, though, the iron ore and coal exports have just been pumping along for Australia. So it's a bit of a mixed picture, and it'll be interesting to see how things play out once international travel comes back online. My sense is I think there will still be a lot of demand from Chinese students and Chinese tourists to come to Australia. So I think, as you said, sometimes the media takes a sensationalist view of these things. But in saying that, it'll be interesting to see what happens when things open up in earnest next year.
Yeah, I totally agree. I think there's a second wave that will continue to support the ongoing strength we're seeing in quite a few sectors of the economy and investment markets as a result. But and I think all this talk about particularly the West's reliance on the iron ore, where we've still got some time in play before China's even going to be able to supply those needs from elsewhere. And, there's all the focus on iron, but with the growth in electric vehicles and the likes of Tesla really starting to increase their need for lithium and other metals, then I think we've got other avenues that mean that we're not as reliant on China as what everyone makes us out to look like. So, no, that's great. So another area I'd love your thoughts on, Pete. The economy generally, apart from some of those hand-to-mouth sectors that are directly affected by COVID, as you've said, with the stimulus monies that are in there and the low rates are doing quite well. What's your read on how long the current strength in the economy is likely to last?
Yeah, well, I think this is the interesting thing. If you go back to the start of the shutdowns in 2020, the stimulus that Australia put in place was among the biggest in the world. Now, there's different ways to measure it because some of the measures were effectively debt and some were stimulus payments. But almost any way you look at it, Australia put in place a massive stimulus. We were quite lucky in the sense that we didn't have a high level of government debt to begin with. So there was a lot of headroom there for Australia to effectively borrow. The government could issue a lot of bonds, and all of the payments that went out there. So there were things like the JobKeeper and the Job Seeker stimulus. The housing market got plenty of stimulus in terms of construction. And also we had the Reserve Bank cutting interest rates, which we did have room to do, and then quantitative easing on top. So the stimulus was absolutely huge in Australia. Also, as mentioned, something that changed about 15 years ago, we used to get more money in from tourism and travel than going out. But as Australia became a wealthy country during the mining boom years, we started to see the overseas trip as something that Aussies did almost every year. So the impact of that is with Aussies not being able to travel, all of those Aussie dollars have been stuck in the domestic economy. And up until a few weeks ago, the economy was absolutely booming back. So unemployment was back under 5%. We had job vacancies at the highest level on record. Construction was booming. It's only really just as we've gone into July and August that a second wave of lockdowns, if you like, has kind of stalled things again. But I think this time around, though, there's a bit less uncertainty because we know now we've got a vaccinable disease and the vaccine rollout is happening. I think in the first wave of shutdowns in 2020, there was a huge level of uncertainty. This time around, I think we can see that there is at least light at the end of the tunnel. So, as you said, very tough if you work in hospitality or some of the retail trade sectors, but by and large, the economy should hold up pretty well. And I think eventually we'll start to see the vaccine getting on top of everything and things will reopen. And with all of that stimulus still in place, I think Australia should emerge in a pretty good state, certainly compared to countries around the world.
Yeah, 100% agree. Talk to us about what you see as some of the biggest economic risks that need to be considered and may impact on investment markets moving forward.
Yeah, look, it depends. There are different markets. You've got the real estate market in Australia, which, as we all know, has got its own divergent trends. The regional markets have been doing very well. Certainly for the past 18 months, a lot of markets have been booming, while some of the inner city markets have struggled, particularly the CBD unit and apartment markets. So real estate has its kind of own unique dynamics and risks. I think in terms of stocks, particularly the US market, valuations are extremely high, and that tends to come with its own risks, particularly if the stimulus starts being tapered off and interest rates start rising. there is potential there for a correction. And certainly one of the biggest trends over the past 20 years that we have seen emerge is that if the US market goes down, it tends to bring everything else down with it around the world. So there is potentially some risk there for a stock market correction. But of course, you could always say that with stock markets, and it's very difficult to predict the timing. I guess there's just some very expensive markets out there in terms of stocks.
Yeah, a fair bit of speculative activity out there for the very reasons you mentioned. Low interest rates, so people have got to put their money somewhere else. Equities looks attractive. It's a lot easier than it ever used to be. So there's a lot more first timers chucking their savings into that arena. So no great surprise in that. But sort of leading on from there, Pete, there continues to be a lot of talk by quite a few of the scaremongers around asset bubbles and pending busts. What's your read of that, both from a equities and a property perspective?
Yeah, I mean, let's face it, we've been hearing those reports for 20 years in Australia in terms of the property market. The stock market has had a couple of major corrections over that time. So, but I guess there's nothing new there in terms of the amount of scaremongering. I think the thing for people who invest in property is that when people talk about the economy and economics, they're very often focused on what's going to happen next quarter. Is the economy going to grow or contract? Is inflation going to be up or down a notch? But for most people who invest in property, they're probably taking a longer term time horizon. Certainly most investors and successful investors are probably looking with a 10 or 20 year lens. And therefore, what happens over the next 3 or 6 months really isn't that relevant to the outcome. So I think there are some risks out there for the property market for people who make ill-judged decisions. But if you've got a long time horizon and you stick to some basic common sense rules, obviously you can remove a lot of that risk, particularly if you're taking a longer term focus. I think, as you said, in the stock market, people do tend to get into trouble in this phase of the cycle, particularly people who are speculating on short-term prices, and in particular where people are using leverage. I think that's where often younger investors do get themselves into trouble. And then you've got cryptocurrencies, which is a whole other level of speculation. So, yeah, there's a bit going on there in terms of risk. So that's why taking a big picture view and ideally a longer term outlook can really help in terms of managing the risk.
No, I totally agree. And I know in my own case, my view of investment is long term. And if I am going long term, that I actually don't care what happens short term, because I'm not looking to buy at the bottom and sell at the top. That's not what the game's about. And if you sort of take that approach, then all of the noise and the fear mongering that the press likes to engage our eyeballs and our ears sort of doesn't really make much difference. But something I'd also, just to again dispel some of these myths that we're talking about. Again, there's been a lot of fear floating in around immigration policy, around the potential inflation that is going to burst out of the blocks as a result of what's happened over the last 12 months. What's your read on those two?
Yeah, look, I don't think inflation's a big risk in Australia. I mean, we've had inflation actually under the target range now since 2015. So arguably a bit more inflation wouldn't be a bad thing for Australia. Yeah. And in fact, potentially the Reserve Bank might even let inflation run a bit stronger than the 2 to 3% target to balance things up a bit. But certainly around the world, there are some markets where there's been some inflation. The US headline rate of inflation is over 5% at the moment. I think the thing to remember about inflation, though, when people are looking at those annual measures, it sometimes it's due to a base effect. So if you look in Australia, inflation fell sharply during the shutdowns, and then as it's rebounded, the headline figures look a lot higher than the reality. If you look at the trend over 5 years, we've really been dribbling along. So I suspect a lot of this inflation will prove to be transitory. And already you're seeing some of the commodities where prices went sky high, like lumber. I mean, prices have just collapsed in recent months. And I think the rebound in things like oil prices is starting to fall away again. So I think there could well be a bit of a spike in inflation, but the trend over the past decade has been for very weak levels of inflation around the world. So it's hard to see that has been reversed in the space of a year. So I suspect a lot of it will pass through, and then inflation will settle down again, most likely.
Yeah, it's a bit of a compressed spring. That's what we've seen. We've compressed the spring for 12 months as a result of COVID, pumped a whole heap of stimulus and money into the system, and it's no great surprise that once that's been released, it's actually sprung out, and then we'll see it sort of come back to equilibrium as a transitionary exercise. You've touched on governments and central banks' approaches. What's your read on likely and potential interventions that they may or may not make moving forward?
Yeah, so if we look closest to home, Australia put in place what was called a term funding facility. So some of those ultra cheap mortgages that we've seen over the past 6 or 12 months, that term funding facility has been wound back now. So I think we've already seen, just at the margin, there's been some little increases in fixed mortgage rates over, well, you would know better than me, Bushy, in terms of the specific mortgages, but maybe 3 and 5 year fixed rates might just nudge higher a little bit.
Yeah.
But I think the big picture is you've got an awful lot of people still refinancing their mortgages down from 4%, 3.5%. A lot of people are actually still refinancing their mortgages lower. So the average mortgage rate across the economy is still trending down. And I don't think we're going to see any changes to the cash rate, probably. I mean, this is not my view. This is the view of the Reserve Bank itself, probably until 2024 at the earliest. So yes, potentially we might have seen the bottom of the interest rate cycle for now, but that doesn't mean we're going to see interest rates spiking higher. And the big picture is people are borrowing at 2 or 3%, and some years ago it was much higher than that. So relatively stimulatory levels of interest rates at the moment, particularly for property, as we've seen. We might not see lower mortgage rates now, but that doesn't mean things are going to go spiking higher anytime soon either.
Absolutely. And I think if you take into account the fact that the government's got to service its own debt, and it's a pretty sizable one, then they'd be shooting themselves in the foot to increase rates from that perspective. And given the reliance of the majority of Australians on the value of their home as a big part of the wealth effect, then it would be fairly short-sighted to start playing around with that. Given that we are likely to be into a comparatively very low interest rate environment, whether it be at or slightly above what it is over the next decade or so, what impact do you think this is going to have on investment and property strategies moving forward?
Yeah, it does make a difference. And for the reason you already mentioned, is that nobody really wants to sit with cash in the bank at the moment. It's been a challenge in Europe for over a decade now. And now it's come to Australia as well, that money that used to get parked in cash or term deposits, it's just not returning anything really of worth to investors. So therefore, people are looking to get their money into other asset classes. So residential property particularly, but also things like commercial property and the stock market. So it does make a difference. And I think you would know, as somebody who spends a lot of time on property strategy, one of the popular approaches in Australia over recent years has been for people to have an investment property, but also to have a mortgage offset or redraw facility so that they can build up a buffer there. But it also means your cash isn't just lazy money sitting in a bank account. It's actually doing something of worth for you while you seek out your next investment asset or strategy. So yeah, look, it does make a big difference because it's made cash very unattractive for investors, and therefore you need to probably think a little bit differently from maybe 10 or 15 years ago.
Yeah, spot on. The in the sort of more medium term, I think what's more likely, and we're seeing it a little bit with some of the banks already, rather than any play around with rates, apart from using the bait and switch tactics, which fix rates because the banks can set them at their will, really. There's more likely to be some toying around with the macro potential levers. And we're certainly seeing that already with debt to income ratios coming in much more strongly in terms of the bank's rating of loan applications. What's your feeling? Because there's a lot of noise in the industry around the potential for much stricter macro prudential interventions alongside the potential relaxation of the lending laws when and if it gets through the Senate later in the year. What's your read on all of that?
Yeah, well, there's two different things. One, what I think should happen, and secondly, what I think will happen. I mean, my view is generally that unless there is clear evidence of a deterioration in lending standards, macro-prudential measures and so on, I mean, it really should just be set and forget. It's very hard for people to make business and investing decisions when the rules are being changed and tweaked all the time. I suspect what will happen is that probably maybe over the next 12 months, we'll see some tweaks and changes at the margin. As you said, we've already seen some bits and pieces in terms of assessment rates and so on. I think this time around, the measures won't be targeted specifically at investors for a couple of reasons. I mean, in 2017, it was all about interest-only lending and too many investors in the market. Well, there was a huge clampdown on that. Interest-only loans are now the lowest share on record. And also investor credit just hasn't been growing that much. In fact, it's only just coming off record lows. So I think if there are measures taken, there will be, as you mentioned, it will be largely targeted at people with high debt to income ratios and maybe some tweaks to high loan to value ratio lending. So I guess what does it mean for investors? Well, I guess something that's really been the case since 2014. If the amount of money that you can borrow or the amount of debt that you can carry as an individual is going to be capped at a ratio of your income, you need to make extra certain that every asset that you own and every asset that you buy is performing to its maximum potential. You don't want to be carrying debt against dud properties or dud assets that just aren't going to deliver for you, because there's a bit of an opportunity cost now. So you should probably look to focus on quality rather than quantity of assets, and just make sure that every dollar of debt in your portfolio is performing to the best of its ability.
Absolutely right. And I think you touched on a very good point there, because we really are seeing a lot of FOMO, or fear of missing out, occurring in property markets in a lot of areas around the country. And we're seeing investors and property buyers generally just grabbing anything for the sake of getting into the market, which is potentially it's going to create some pain and heartache down the track. Given the buyers business that you are now driving, and this is probably a good time to expand on that a little bit, because we are in an environment where I think more than ever in a seller's market where buyers are really struggling to get their hands on property. There's no better time than to engage a really good buyer's agent to be able to navigate and negotiate their way through that on buyer's behalf. Give us a bit of a rundown in a bit more detail around how Buyers is actually sort of capturing a national panel of good quality buyer's agents that can help buyers of any description to negotiate through the current seller's market that we're confronted with.
Yes, well, I guess there's two main services that we provide. One is property strategy. So we do a 10-year property plan for, especially for investors who don't really know what their strategy is or what their next step should be. And then secondly, as you mentioned, we have a property buyer's agency service. And the way our business is set up is that we've got buyer's agents that cover the whole country. So whether you're investing in Sydney or Melbourne or Southeast Queensland or indeed any other parts of the country, we do have a local presence there. We've built a panel of high quality buyers agents. So we're not in any way incentivized to push people into one market or another. What we really want to do is help people make the best decision for their particular circumstances and situation. And the good place to start out really is with a 10-year property plan and to work out what the next step should be, but also to try and begin with the end in mind and try and work backwards to the best decisions for you today. So yeah, I guess that's just a high level overview of what we do. So it's property strategy advice, but also assistance when purchasing a property.
Yeah, no, brilliant. Tell us, Pete, given the activity that buyers is having across the country, what locations are clients buying and seeing value in at the moment?
Yeah, look, it depends on the price point. So for investors with 7-figure budgets, well, the types of markets that have been popular, places like Brunswick or Coburg in Melbourne or Windsor in Brisbane, those kind of sort of inner suburban detached housing markets. But obviously, not everybody as an investor has 7-figure budget. So I think there's definitely been a shift in recent, certainly the past couple of years. There's been a shift away from density. So a lot of people are much more inclined to buy houses on good blocks of land at the current time, more so than units and apartments, which have struggled for the reasons we already discussed. I think the lack of international tourism, the lack of international students, and also just a general shift in demand away from the denser markets, which kind of makes logical sense during a pandemic. So for people with the sort of somewhat lower budgets, well, the kind of areas that have been popular, parts of the Gold Coast like Southport, some of these sort of peri-urban locations in regional markets, so places like Cessnock or Beresford in New South Wales. So there's kind of been a shift away from density, and it depends on the price point, but Southeast Queensland has been very popular because of the interstate migration up there from Victoria and New South Wales. And even down your way, Bushy, Adelaide has definitely come into focus for people because very tight rental markets down there and relatively attractive price entry points. So I think just a general shift away from density and towards some of the more detached housing markets away from the centres of the cities.
Yeah, and there's been it's almost become a bit of a theme recently. Everyone's talking about the decentralisation and the run to the regions. What's your view on that in terms of one of its relevance and two, its permanency?
I think that is one of the risks why. If people pay too much in a regional market and trend goes into reverse, then that could be an exposure. I mean, I don't think it's as extreme as we saw during the mining boom years. I think at that time, people were paying incredibly high prices in regional markets around Australia, and they got caught out. I mean, I don't think it's as extreme as we saw in some of the mining towns, but nevertheless, want to be ideally want to stick to the markets where demand is going to be strong over the medium and longer term, rather than getting too exposed in some of those smaller or remote regional markets. I think when immigration comes back online in 2022, I think we will see. I mean, migrants in Australia, roughly 90% of them go to the capital cities. So I think Sydney and Melbourne will come back to life as the main destinations of choice for migrants. But I do think we'll see some of that working from home or working remotely trends. I think some of that will stick. So I think we'll have a bit of a hybrid model going forward where people aren't necessarily in the office 5 days a week, as we used to expect. So I think there'll be a bit of both going forward. Some of these trends will reverse and some will stick around.
Yeah, I think for investors in particular, they need to, if they're following the regionalisation because of the cheaper price points potentially, then they need to make sure that once the artificial sort of petrol from COVID has been thrown on the fire and that's evaporated, they need to be focusing on populations that have got a critical mass, they've got diverse industry, so that there is not reliance on one particular employment side of the equation. So, and it needs to be underpinned by technology because, as you say, if we're working from home, then we need access to the internet and everything else that goes with it. So don't just chase regions because it looks cheap. It's the same old argument as the mining towns back in the resources boom. We're seeing a lot of the people, they can't get in anywhere else, so they're just chasing anything they can get their hands on. That they need to underpin that with a pretty solid framework of the key drivers that will maintain its ongoing performance long term. So, mate, another thing I'd love to sort of dive into a little bit, because a lot of property investors only look as near as their backyard and almost have a fear of looking further beyond. But you and I both know if you're going for growth, then quite often there's a lot better and more sustainable growth in other locations away from where you're living locally. What are you seeing as the merits and the drawbacks of buying property interstate, given the sort of borderless approach that buyers takes?
Yeah, I think it does make a lot of sense. We get a very common inquiry type for us is people in Sydney or Melbourne. They might have a place of residence in Sydney or Melbourne, and an investment property these days can come with quite a high price tag. So therefore, people think, well, A, to diversify, and B, to get into more attractive price entry points, it might make sense to look at maybe Southeast Queensland or Adelaide or a regional market. So it makes sense from a couple of perspectives, really. One is price entry points, and the other one is to get a nice spread of assets so that you're not fully exposed to one market. I think for people who grow a bigger portfolio, then it does have land tax implications as well, because if you've got all of your assets in one state or one location, then land tax comes into the equation for some investors. So it comes with its own challenges as well. You may not be as familiar with interstate markets, so there's a bit more research or understanding to be done. The buying process is different in different states, so there's a bit of learning to be done there, and also just the practicalities of managing a property that isn't on your doorstep. You need to have a good property manager in place to manage that. So look, there's a few pros and cons, but if you're looking purely through an investment lens, then it kind of does make sense to get an exposure to several different markets rather than focus all of your assets in one area.
Yeah, spot on. Yeah, as we speak, there's really strong demand for good quality properties, and there's not many of them for sale at the moment. And we're seeing a lot of buyers having to pay more. What sort of, and given the expertise that buyers has across the country, what sort of negotiation strategies can buyers use to secure properties in the current sellers market?
Yeah, I mean, it depends on the market. I mean, some of the markets around the country are extremely tight. In parts of Brisbane, not so much for units and apartments, but if you go to sort of family appropriate houses, you can have huge numbers of inspections and a lot of offers happening in the first week, and it's a very competitive buying environment. I think that's one of the ways in which a buyer's agent can really help out with investors and home buyers, is that firstly, they can make decisive offers pretty quickly because they look at properties all the time, but also they can get access to either pre-market or off-market properties. So that can sort of help to short-circuit the process. So because they speak to real estate agents every day, then they tend to be front of the queue when there's new properties coming up for sale. So there's a few different ways that you can go about it. I mean, I think having the right plan and strategy in place in the first instance helps because you can be a lot more decisive. Yeah. But also you need to be able to act quickly, and that's where having all of your finance and all of your ducks in a row before you pull the trigger obviously makes a big difference to how quickly you're able to move. I think in some markets, buyers are making offers which aren't conditional on finance or aren't conditional on building and pest inspections. That can come with its own risks, though. So you really need to understand what you're doing before making any kind of unconditional offer, because you could end up picking up problems that you weren't banking on. So, there's a word of caution in there too.
Yeah, you're singing my language there. Given the dynamic nature of bank policy at the moment, and it literally does change by the day, and it's been doing that for quite some time, to blindly going and making an unconditional offer, assuming that you're going to get the finance based on a chat that you might have had with the bank last week or even a broker last week, doesn't mean it's going to hold water in 2 or 3 weeks' time. So I'd be very much cautioning buyers to be very careful in making unconditional offers unless you've got the cash in your hand in full. So, but if you're borrowing money, I'd be very nervous about doing that. But let's focus in on the buyer's agents piece at the moment. Why don't more Aussie buyers use buyer's agents, in your opinion?
I mean, there's different reasons. I mean, if Australia in many respects tends to be a hybrid of what's happens in the UK and America. So in the States, maybe half of transactions these days go through a buying agent. In the UK, it's only really been a London phenomenon. So Australia's a bit of a hybrid. We tend to do home buying purchases ourselves as a rule or on average, but where people are investors or where they're buying interstate, buyer's agents have become more popular. I think part of the reason is the cost as well. I think a lot of people would like to use a buyer's agent, but sometimes the fees can be prohibitive, particularly for first home buyers. So people figure they'd rather take on the responsibility themselves. So I think there's a few different reasons, but the market share is growing for buyer's agents. But one of the things we're trying to do is grow that market share more quickly by offering a range of products. So we offer the full end-to-end service, which is traditional, but we also offer just a straightforward negotiation and acquisition service for people who've already identified the property or location they want to buy in. And obviously that's a much cheaper service, more in line with what you might pay in the States. So there's a few different reasons, but I think as the world goes towards a more digital approach and as people become more familiar with the services, I think the market share will grow over time as well.
Yeah, good call. And I mean, I'm a big supporter and advocate for buyers agencies because very simply for me, if you're the 15 or 20 grand that you're spending on a buyer's agent, if they can locate a property that's even 1%, has a growth rate of 1% better over the 15 or 20 years holding the property, then that 15 grand pales into insignificance when it comes to the outcome that you have. And from where I sit, removing the emotion from the property transaction is a big part of what buyers agents can bring to the table, so that they de-stress the situation, but they're also able to negotiate more rationally and make sure that the buyer is not caught up in the FOMO activity and getting the wrong property at the wrong price. So, that's great, mate. Look, always appreciate your input, mate. I always feel like we could talk for hours, and it gives me another excuse to continue to get you back on Get Invested, Pete. But I always like to finish off the discussion with what I call the ambush round. And while you've played this game a couple of times, I'm going to shorten a little bit so it's a bit easier for you. But would love for you to share another favourite quote of yours and why you think it's good.
Yeah, well, actually, funnily enough, it came up in the conversation, and it was one of the things that Stephen Covey talked about in the 7 successful habits, or the 7 habits of highly successful people, and that's to begin with the end in mind. I think, particularly when people are talking about economics or jobs figures and data, they get very, very bogged down in the here and now. Without really taking a bit of time to take a step back and think about why you're actually getting involved in investing, whether it's property or stocks or Bitcoin or whatever it may be, are you doing it just because everybody else is? Are you doing it for another reason? I guess what people often fail to do, and this is where you've had such a big impact in the market over the years, is people need to really take a step back and think about why they're doing what they're doing and what they're hoping to achieve. And if you can begin with the end in mind, then you can almost reverse engineer your strategy. So that is it's a key quote. I remember when I first read about that, I thought it's such a clever phraseology, and it does make an awful lot of sense, particularly for people who are investing in property, because real estate is an asset class that can really help you to grow your equity. But I think often people haven't really thought about, but how does that actually help me get to the lifestyle and the end game that I want? So I think that is definitely one of my favourite phrases among many others.
Mate, absolute music to my ears, mate. That's it's certainly singing the tune that I talk to people about every day, mate. And you're absolutely right that most people focus on the property; they don't focus on the lifestyle they're trying to achieve and how that property is going to contribute to that. So, love hearing that. What about a current top book that you'd recommend the listeners read, and why?
Yeah, well, it's actually it's worth having a listen to. So I've got a podcast called Low Rates, High Returns, and we just did a mini series on our top 10 investment books of all time. Now, these are largely books about the stock markets, but not exclusively. The books I've been reading recently, well, I've got so many on the go, it's difficult to pick one. I've very much enjoyed the Nassim Taleb series. So it's not just one book. He was most famous for The Black Swan, but he actually has done a range of books, and they're not just about investing, they're just about life in general. So I found those to be very useful for giving you a different perspective on the world, especially in terms of dealing with the unexpected, because I guess in the end, that's what we have been dealing with over the past 18 months, a pandemic. I guess you could say, pandemics do happen and have happened before, but it does give you some really interesting perspectives on how to build a life that can be flexible enough to deal with the unexpected events that always come around. I think people often act surprised or shocked when something unexpected happens, but the reality is that these things do happen. So you need to have a plan that can be flexible enough to deal with that.
Yeah, spot on. Last one of these, mate, for you. What's another personal habit of yours that you think contributes most to your investment success?
Well, I mean, for me personally, it's largely been because we've done it jointly together, me and my wife. I think, look, it's different for different couples, but, I think we've always found that the benefits of having sort of open and honest discussions about our investment plans and life plans, I think you could be fighting a bit of an uphill battle if you're both not on the same page. So I think for me that has been probably, you talk about the 80-20 rule and some things making a bigger difference than others. I think for us, having regular discussions about what we're hoping to achieve and why, I think that has probably made a bigger difference than almost anything else to me. And in fact, as we probably talked about right back on our first podcast, it was actually my wife Heather who got me interested in property in the first place. So I guess if you include that into the equation, then it's probably made a bigger difference than anything.
Yeah, very good call. And my wife Sonia and I are exactly the same, mate. It's a real yin and yang. And there's no way I'd be enjoying the lifestyle I do now if it wasn't for that collaborative effort and the robust conversations they have. There's some checks and balances that go with that as well, which is also very useful in that context. Mate, final question, and this is not meant and intended and won't be financial advice in any way, shape or form, but what would you be doing if you are just starting out an investment in Australia? And you've got solid income and you've got a bit of equity or savings stacked away. What would you be investing in now and why?
Look, everyone has different circumstances, preferences. With all of those disclaimers out of the way. Look, if it was me right now, I would probably buy I would probably buy an investment property, probably look at some of those markets that I mentioned, places like the Gold Coast or Adelaide, or maybe one of the regional markets. I'd build up a balancing and offset facility, and I'll be waiting for some better opportunities in stocks, because I think we will get some over the coming years. So that's what I would do. Obviously, everybody's at a different stage in their journey. People have different preferences as to asset classes. I think real estate's going to have a good 10 years because we'll have lower mortgage rates than we've previously seen. I think stock markets, I think they'll do fine over the long run. I'm just not saying it's a particularly attractive environment right this moment. So look, that's what I would do. I'd buy a property. I'd build up an offset facility as a buffer, but also to give me some option value or optionality on stocks. And then I would look for cheap stock markets or sectors around the world and wait for a better opportunity.
Yeah, I love it, mate. Awesome thoughts, as always. Now, you mentioned a couple of the other activities you're involved in. So for those listeners who have really pricked up their ears and they wanted to hear more from you through your blogs and podcasts and or buyers agent, buyers and others, how can they contact you and how can they do more with you, mate?
Probably the easiest place to track me down, petewargent.com, or I do write a daily blog, Pete Wargent Blogspot. So there's heaps of places to track me down, but for people who like my daily musings, that's a good place to go for some free content. I also have podcasts and other bits and pieces, but those are probably the easiest places, and you'll work it all out from there.
Yeah, and buyers.com.au is the obvious place for buyers. Anything over and above as far as buyers is concerned?
Yeah, look, subscribe for our newsletter. We put out weekly content every Friday. So that is a good place to go, buyers.com.au. If you're interested in property strategy, we do an affordable 10-year property plan, so that's worth a look. There's plenty of free market research tools and insights that you can find on the website there as well. Things like property valuation reports, property risk reports, and also research on individual markets. So there's heaps of free tools and insights there that you can get for free.
Fantastic, mate. Always love having a chat to you, mate. I'll continue to get you back on the show regularly. I know Buyers is doing some great stuff in the marketplace, and we'll really encourage the listeners to jump on the website and get their hands dirty with what you're doing in that space.
Fantastic. Really appreciate the time, Bushy. It's always great to chat with you, and thanks for the opportunity.
Likewise, mate. We'll talk again soon.
Cheers. Thanks very much. Cheers.
Get a summary of all this investment gold in the show notes. Just email me on hello@khgroup.com.au. That's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/get invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening. And as always, dream as if you'll live forever and live as if you'll die